Okay, perfect. All right. So this week, we're gonna discuss financial statements, and I think it's a pretty big topic. So we might have to break this up into two sessions. I was finishing up the presentations last night and it was a lot. So here's what I'm thinking. You guys feel free to give me feedback. I was thinking maybe we could do the whatever I have in the presentation for a good 40 minutes and then go into examples and questions, or we could do a full hour, go to examples and questions, or do you guys want to try to do the full hour and a half of just the presentation? What are you guys thinking? I was thinking about breaking it up, but I'm open to what you guys want to do.
I think it might be a decent idea to do the whole presentation, and then that way we have some time to digest, and then we can come to the next meeting with questions, and the next one could just be like a whole Q&A.
Okay. All right. All right. I'll try my best to go through because it is a big, we're doing income statement, balance sheet, and cash flows. So I'll try my best to get through it all. But if not, we'll finish the rest next week. So that's fine. Another thing I wanted to get your guys' consensus on. I feel like, we don't really have space to discuss like ideas and what you guys are working on and having like that space of group thing. I was thinking about maybe just meeting with you guys. In addition to the Saturdays, we meet maybe like on Wednesday or Tuesday evening just to strictly talk about ideas, what we're looking at, what we're researching. How do you guys feel about that? Just to get like, some of that hands-on with the research as we're going along with the program.
I really like that idea.
Yeah,
Yeah.
I'm open to that as well.
Okay, yeah, I just feel like, we got to create space just to talk about ideas, or we don't get that group thing going. Okay, so cool. So we'll do that. All right, let me get the presentation up and we could just dive right in. Uh, just give me like 30 seconds. And I want to encourage you guys on this topic to definitely take notes and stuff. And feel free to stop me and ask questions because I know the accounting stuff can just get very intricate. All right, present. All right, so this we could do on financial statements, right? So the agenda is the income statement, balance sheet, and statement of cash flows. All right, so part one. Financial statements are documents that report on a company's financial performance, business activities over a period of time, right? Annual reports, quarterly reports, monthly statements, etc. The three main financial statements are the income statement, balance sheet, and statement of cash flows. All right. An income statement is a document that tells us if a company is operating at a profit or a loss for a given time period, right? So the net income is total revenue minus total expenses. So pretty straightforward, just a profit and loss document. So wanted to define revenue here. Revenue is the total amount of income generated by the sale of goods or services for a company. And there's three types of revenue. There's operating revenue, non-operating revenue, and then there's gains or losses. We're going to define those here. So operating revenue is revenue achieved through the sale of products or services. Non-operating revenue is revenue that's received through non-core business activities. So like interest earned, rental income from business property, things like that. So these aren't things that, they're not selling their products, but they did have some sort of cash flow into the business because of whatever reasons. Actually, just going back to this, except for like financial companies, like let's say like, it's an asset manager and stuff like that, right? Rental income from a business property would actually be an operating revenue. But let's just say like, you're a consulting company, and you just happen to own the building that you work out of, and you also get rent from the tenants or something, like, then that's non-operating revenue. Just want to make that clear that, investment income can be operating revenue if it's like a financial company or like an asset manager or something, because that is their core business, is investing. Now, gains or losses is money made or lost from one-time non-business activities like the sale of a long-term asset, unused land, or a subsidiary company. So these aren't, once again, these aren't core business activities, but it is still revenue, right? And sometimes things like gains or losses could really inflate or deflate earnings. So you got to go through the income statement and see, like, when you're seeing that revenue growth or decline in revenue, you just going back to those three topics. You want to know, like, is revenue growing because of operating revenue, which is a good sign, or is it like a one-time thing, as in gains? And if it's gains, you might say, hey, this company doesn't have the best growth rate. They just happen to sell a building, you know. Francis, you have a question?
Yeah, will we be getting this presentation sent to us?
Yes. So I'll send it again in the chat. And I sent it during the break, but I don't think anyone responded. But I sent the folder of all the presentations, and I also sent the YouTube link. So I'll resend it after the call, just to make sure you guys have that.
Okay, thanks.
Yep. All right, let's keep going. Losses can also be expenses towards like lawsuits or other one-time unusual costs, So before I move forward, anyone have any questions about revenue or the different types of revenue for a company?
Could you like go over the different types again, or?
Yes. So there's three types: operating revenue, non-operating revenue, and then gains or losses, right? Operating revenue is revenue that's achieved through the sale of products or services. So a company's core business activities, like, let's just say, Francis, you are a fashion designer, right? And you're in the business of selling clothes, right? Whenever you sell your clothes or your hats or your accessories, whatever, that's operating revenue. Let's say you happened to like give somebody a loan for whatever reason through your business, right? And they're paying you interest, right? That's non-operating revenue. You're still getting revenue, but that's not your core business. Does that make sense?
Okay. Yeah.
Okay, cool. And then you have gains or losses, right? Which is money made or lost from like one-time non-business activities. So once again, let's say, like, I remember I used to work for that lady for Lockie. She had her fashion store.
Yeah.
She owned her store. Her core business is selling clothes. So when she sells her clothes, that's operating revenues, right? But remember, she left the US and she sold her store. When she sold her store, that is a one-time thing that she does with that business, and she'll get a gain on that. Does that make sense?
Yes.
And does it make sense to you why accountants, the accounting standards make these three different categories? Does it make sense for you why they're doing that?
I think so. Yeah.
Okay. Yeah, right. And they break it up into these three different categories, so you have a really clear picture of where money is coming from.
Right. Yeah.
Yep.
I have a question. I think that the difference between non-operational revenue and gains or losses, um, could that possibly be synonymous? Like, could a transaction be considered both non-operational revenue and a gain, or expense and a loss?
I think it can, but I think that the key distinction is that with the gains, is that the gains are usually just one-time non-business activities where, for example, right, when they're talking about like interest earned, you could be collecting that interest every single month, right? That's not a one-time business activity. So I think that's the key difference. But in theory, they are the kind of the same thing, because they're both not operating revenues, right?
So for example, I'm sorry. So if this woman decided to do like a wardrobe consulting, that could be considered like a non-operational revenue because it's not the core business, which are the clothes, but it could also be like a recurring income.
I wouldn't say that, right? If the person is doing if the person is a designer and is selling clothes, but they're also doing consulting, then that's just another service under the operating revenue. So that would be operating revenues. Does that make sense?
Yeah, I think I understand. Thank you.
Yep, you got it. I think someone else had their hand raised. Okay, no, I guess that was Francis from before. Okay. Anyone else have any questions? Oh, okay, we'll continue. And yeah, feel free to stop me anytime, guys. Now, the other part of the income statement is expenses, right? An expense is any item that a company spends money on to generate revenue for the business. So there's, once again, 3 types of expenses. There's operating expense, there's non-operating expense, and there's capital expenditures. And also, peep how losses, right, which is an expense, falls under falls under this gains or losses category, which is a type of revenue, right? Losses, these one-time unusual expenses like a lawsuit, doesn't really fall under expenses.
Why is that?
You know, that's a good question. And so in the US, and maybe I should have started with this, we have what we call the generally accepted accounting principles, and that's like the national standard for how accounting should be done, right? So that every, because if you don't have standards, then all kind of companies going to have different methods for tracking money and whatever. So that's kind of the rule they made up. I do want to say, of course, I know a lot of these things, but I'm also like not a deep accounting expert, but I just want to say these are the gap rules, but we could look into that and I'll follow up with that question. But yeah, all right. Okay, so the 3 types of operating expenses, right? So an operating expense is an expense related to the operating activities of a business, such as cost of goods sold, administrative costs, rent, etc. Then there's non-operating expenses not directly related to the business's core operations. And that could be interest charges, so that's money you're paying on a loan. Other costs associated with borrowing money. Those are usually like the kind of non-operating expenses people are encountering. And then there's capital expenditures. And I think this is a very important term to know. And as you guys are researching companies or even listening to like analysts talk about companies on CNBC, I think this is a term you're going to hear about a lot, CapEx, and that's capital expenditures. And that's funds used by a company to acquire, upgrade, and maintain physical assets, such as property, plants, buildings, technology, or equipment. So just going back to the fashion designer example, like let's say, Francis, you are like the hottest fashion designer in New York City. You're so in demand.
Amen. I received.
Yes, you might say, hey, I want to go and build the most beautiful store to attract customers. The money that you're spending on construction and this, that, and the third is an example of capital expenditures,
Yes.
Or yes, I know you receive. Or let's just say, you are, let's say once again, you are this fashion designer and you want to step into technology, right? And maybe you want to build an app that lets people like could see their clothes on in VR, right? And you gotta like, or people can try on clothes in the metaverse, right? But you gotta build out like that software or that metaverse experience, right? That would also be like a capital expenditure. So yeah,
Makes sense.
So yeah, once again, I think the key part about this is funds used to like upgrade and maintain like physical I don't want to say physical, I want to say tangible assets. Because software may not be physical, right? Because software is like, but it's tangible. So yeah. So I just keep that in mind. And now, it's important to understand the 3 levels of profitability, right? So you have gross profit or gross margins. I'm just using the terms interchangeably. You have operating income or operating margins, and then you have your net income, which is your your total profit margin. And it's important to understand a company's profitability and what that company needs to do to either become profitable or scale profitably, right? You might have a company that's doing $1 million in revenue, but the company literally costs, $2 million to run, so their net income is negative $2 million, or their operating income would actually be negative $1 million. So as an investor, you might say, hey, this company has a great product and a great potential, but what does this company need to do to go from being negative $1 million in sale, a negative $1 million in operating income, to being positive in your operating income, right? So I just want to say, that's a question. If you guys are ever dealing with companies that aren't profitable, I know a lot of you guys are doing tech investing, which most of them are not. You got to always be asking yourself, what does this company need to do to achieve profitability? And usually the answer to that is like, hey, if we could achieve 100,000 new customers, we could be profitable. It's usually that's usually the scenario, scaling up, or, they might say, hey, we have plans to cut costs. Maybe they're going to implement some new technology that doesn't have to allow them to hire so many people, whatever the case might be, and that's going to help them reach profitability. So I just say that as you're researching companies, you want to understand that. And if you can't find that through your own research, or maybe to talking to other people, never be afraid to reach out to investor relations. But I see some hands are raised, so I want to take the questions.
Yeah, Jeff.
Yes.
So I don't know if you said this or not. I kind of stepped away for a quick second, but in regards to when you talked about if a company has negative, I think you said their income or their net worth is negative.
Yes, the operating income. Yes.
Yeah. Would that be considered if they have sorry, I'm trying to frame my question here. So would that mean that if they're negative, would that mean their expenses is more than their income?
Yep.
Okay.
And that's exactly what it is. And I want to say there's a lot of companies like that. For example, Amazon has been around for maybe almost 30 years. I might be wrong, but something like that. They were around from the late 90s. Amazon became profitable only 5 years ago. Jeff Bezos is a whole billionaire and everything. They were never a profitable company until just a couple of years ago, so that's just to show you a company, and let's just pull up their stock chart just for you to see, right, how a company could not be profitable, but still have one hell of a run in the market. But even though they weren't profitable, they were always growing revenues. So let's see. So this doesn't go back to the beginning, right? But you guys can see the growth of Amazon and just this whole ride. Of course, revenue was always growing, but they were never a profitable company. Just wanted to put that in perspective for you guys.
Wow.
Good question. They didn't do that completely to escape corporate taxes. What they're doing, and I was studying Amazon at the time. So one thing, even though Amazon overall wasn't profitable, and I gotta define the difference between operating income and net profit margin, and you guys will understand that. But they always had profitable at their operating income level, they were profitable. At their net profits, they weren't profitable, right? So what they were doing is just a lot of reinvesting their money, right? They're making huge acquisitions. They're building out the technology infrastructure with AWS. They're scaling up their operations. So it's not that they're also just trying to avoid taxes, but they were also doing a lot of investing that led to rapid growth, right? Whether it's buying out other companies, they bought Whole Foods, they bought all kind of companies that we've never heard of, and then they also really built up their technology infrastructure, and they offer all kind of technology services on the back end. So yeah, it's not like they're running running profitability to pay no taxes, they definitely do take advantage of that, and that's something to understand with taxes too. Our tax system is set up, of course, tax evasion is illegal, right? But everyone is just, and that's just human nature. We're all trying to do our best to pay as little taxes as possible. We just don't like when billionaires do it, right? But we're all like, we got to do our accounting every year. Everyone is trying to pay as little taxes as possible. So that's just the game in capitalism. Okay, so yeah, we're going to get into these definitions. Andrea, thanks for joining us. Don't worry, this session is being recorded. So, you guys will get this.
Sorry, Jeff, I have another question before you move on.
Yes.
When a company gets funded, right? Like say they get funded for like hundreds of millions of dollars, where does that come into play? Is that an expense or an income?
That comes into play on the balance sheet. So we will get to that, but that's a good question.
Okay.
Yeah, good question. All right, so let me just backtrack, right? There's the 3 types of profitability, or 3 levels of profitability. And let me just show you guys this real quick while I'm visible, so you get to see what that looks like. So this is an income statement, right? So they have the total revenue, then they have the cost of revenue, right? Then they have the gross profit. Then you have your administrative expenses, research and development, whatever. Then you have your total operating expenses. Then you have your operating income. Then you have interest. Then you have taxes. And then you have your net income. So do you guys see how there's like 3 levels, right? First, you have your revenue and then the cost of goods sold. And then you have your gross profit. Then you have your operating expenses. Then you get to operating income. And then, you have taxes and interest income or interest expenses. And, then you get to your net income. So I'm going to define all these things. I just wanted to show you guys how it works down the income statement.
So what's the difference between total revenue and cost revenue? You said cost revenue is cost of goods sold?
Yeah, so I'm going to define it now. So just stay with me, right? All right, so yeah, gross profit or sales profit or gross margin, these are usually the terms you might hear, is the difference between your total revenue, like you're asking, Francis, and the cost of making a product or providing a service before deducting like overhead, payroll, taxation, and interest payments, right? So cost of goods sold is literally the cost of making a product. Let's say you are a beauty brand, or let's not say you're a beauty brand. Let's even use a simpler example. Let's say you just have a t-shirt business, right? Your cost of goods sold are going to be like, the t-shirts, the money that you have to spend to buy the, like, the plain t-shirts, and then the cost of making designs that go on the t-shirts, and then the cost of actually putting designs on the t-shirts, right? That'll all be the cost of creating the good, so paying employees, paying taxes, right? That doesn't create the good. Does that make sense? What cost of goods sold is for you guys?
Yeah.
Perfect. Okay, and I guess I define it here. Sorry, someone has a question?
No, I was saying basically how much you're spending to make that product, and then once you sell the product, like what's the profit of it?
Yes, perfect. You got it. So cost of goods sold is the cost of acquiring or manufacturing the product that a company sells during a period. Cost of goods sold doesn't include overhead expenses, sales and marketing expenses, strictly just the cost of producing goods to be sold by the company. The higher the cost of goods sold, the lower the gross profit for a company. And that's just something to keep in mind, right? And as you guys are researching companies, you want to see that these companies, in all aspects of their business, are working towards lowering their costs and expenses and increasing their revenue. I think that's the ideal place where you want to be for an investment, at least for a long-term investment, right? And now, what does cost of goods sold tell us? Cost of goods sold tells us how a company is able to manage labor and materials in the production process, right? Let's say, once again, going back to the t-shirt business, you might have you might have 2 companies with t-shirts, with a t-shirt business, right? both are selling their t-shirts for $20. Let's say both are selling t-shirts for $20. One company, no, sorry, both are selling t-shirts for $50. One company, it costs them $30 to produce that t-shirt. That's their cost of goods sold. The other company might cost $15 to produce that t-shirt. So they're selling t-shirts at the same price. And let's say they both sold 100 t-shirts for the year, but the company that was better able to manage their cost is going to be more profitable. Does that make sense?
Yeah.
And so you see,
I'm sorry, would that mean they have like a greater profit margin?
they have a greater gross profit margin.
Okay.
Not necessarily just working down the list, right? Because then you have your overhead expenses, your rent expense, whatever, and that goes into the total profit, but just the gross profit margin level. Yes.
Got it. Thank you.
Yep. And I want to say, right, a lot of these things is more so for comparison, right? If you just look at a company and just their current income statement, looking at cost of goods sold doesn't tell you anything, right? But if you look at either the increase or decrease in cost of goods sold over time, meaning like, hey, I looked at the last 5 years of financial statements and I'm seeing a gradual decrease, then that tells you something positive. Or when you're comparing them to their peers, like I just did in this example, right? So I just want to say, like, if you look at these things, just one income statement by itself, it doesn't tell you much. But when you're comparing it to the past, and when you're comparing it to competitors, that's where you're really getting that information for, is this a good investment or not? Does that make sense? I'll take that as a yes. Okay, now we have operating income. So operating income takes the gross profit and subtracts all operating costs to give us the profitability of running an operation. Operating income gives us a pure look at the profitability of an operation because it doesn't include expenses like taxes, interest expense, etc. It's just purely the operating expenses. And this is something that I look at very closely because I feel like, once again, companies can be profitable, and after you pass, let's just go back to the income statement over here, right? After you pass the operating income line, you open up to a lot of financial trickery, right? So operating income is very pure, right? I'm running my business. What are the expenses? What are the revenue? Are my total operating expenses less than my revenue, etc. So that's why I like to look at operating income a lot more than net income. Of course, you gotta look at net income, but I just look at this more because I just feel like it's a real clear picture of what it costs to run this business and if this company is being ran well. Any questions on this?
Nope. So you said you look more at operating income so you can get a more of a clear picture of how the health of the business.
Yes, right. Because for example, crap, I didn't mean to do that. Right, when you're talking about interest income, taxes, and you have like depreciation and amortization, and they don't have these things in here right now. But these things really can like inflate or deflate net income, and maybe you guys aren't too used to this, but as you guys start researching companies more, like you'll see that, right? Like a company will like just have this random like $3 million in interest income, right? But that's like maybe like a one-time thing, and that's not really reflective of the operation. Does that make sense?
Yeah, I think so.
Okay, perfect. Okay, yeah, and a company that can show positive operating income means that management is doing a good job of managing its labor force and expenses as it relates to incoming revenue. You also want to compare the operating income of an investment opportunity to direct competitors in this industry. A company that has a higher operating income than its peers potentially means that the company is running a more efficient and profitable company. But keyword here is potentially, so at first glance, it may seem that way, but then you still got to investigate the company. And now net income. Net income is an entity's income minus cost of goods sold, expenses, depreciation and amortization, interest, and taxes for an accounting period. So once again, this area around depreciation, amortization, interest, and taxes, there's a lot of room for financial trickery, you know, for companies to inflate their earnings.
And when you say interest, is that like, where did that interest come from? Is that the company taking out a loan or something?
Yep. The company has taken out a loan and they got to pay, like, you know, their monthly interest payments or whatever
Right.
the case might be.
Okay.
Yep. So that's not, you know, the interest payments aren't really operating revenue, right? So that's why it doesn't fall under operating income, but it is still an expense. Yeah. And I keep talking about inflating earnings, but inflating earnings is an extremely real thing. And as you guys research companies, you will come across this, right? So companies can sometimes inflate earnings with the use of non-operating expenses and revenue. Just like with operating income, you also want to compare net income with one investment opportunity with the past performance and with that of its peers.
Wait,
So
I'm
now,
sorry. Can you go back and explain that again?
okay, which one? Net income?
Companies can sometimes inflate earnings with the use of non-operating expenses and revenue. How do they inflate their earnings like that?
Because, all right, so like here's an example, like depreciation. Let me get you guys the definition, because I know what it is in my brain, but I want to give you guys
Depreciation is like when you lose the value of something.
yes, right. So like, let's say you're a pizzeria. You know how the pizzeria have to buy those huge ovens or whatever, you know? Depending on how you decide to report depreciation, let's say the thing is the oven is good for 10 years. Let's say maybe say it's a $50,000 oven. It's good for 10 years and they're just gonna depreciate it. Let me just see what's 50,000. I just want to do some math real quick. And they're gonna just depreciate it at like $5,000. They could depreciate it like, you know, $5,000 a month or whatever, you know. I mean, not a month, $5,000 a year. So after 10 years, the value of this on paper will be zero, you know. Or they can say, to increase profitability, they can say, hey, let's depreciate this thing at $2,000 a month, right? And now, you know, there was no added income, right? But now they're reporting a higher net income. Does that make sense?
So when you say if they're putting that, you mean like on their taxes, like they're putting like that equipment as depreciating? That could,
Yeah, not on their taxes, but on their income statement. So I want to write it down, right? You have item A. Let's say item A is $50,000, right? And a company can choose how they want to report depreciation, right? They can say this asset is, let's just say DEP means depreciation is equal to $10,000 per year, right? The company could easily say, what you call it, DEP depreciation equals $2,000 per year, right? So now let's just say, let's say before depreciation, the income is $50,000 for the year, right? So now when you include depreciation, you have $40,000 in total net income, right? Now in the same example, this company has $50,000 in income before depreciation. Now after depreciation, they have $48,000 in net income, right? You see how the companies have the exact same piece of equipment, but just because of how they're reporting depreciation, there's an $8,000 difference in profit.
Mm-hmm.
So you see how that's like that could be easily be manipulated, financial trickery, right? So yeah, so that's these are the ways that these companies can inflate earnings and stuff like that. So you got to like be able to investigate these things. This idea or concept around inflating earnings makes sense to people? Yes. Okay.
So that example, that means they could put down whatever they want, or
in theory, yes.
wow.
Yeah. I mean, but even though whatever they decide to put down, though, they do have to stick with it. So that means every year they're always going to have to report this depreciation of $2,000, or every year they're going to have to put down this depreciation of $10,000. But it is kind of up to them, right, to decide what that depreciation is going to look like. And in an idealistic world, right, assuming that everyone are good actors, right, you would expect people to be honest and say, hey, this is depreciating at this rate. But we are all human beings and everyone is trying to get ahead, Yeah. So it's just a real thing. If people can, bend the line a bit, they're going to bend the line a bit. And that's just human nature. And yeah, and we know white collar crimes, nobody goes to jail. Okay. All right. So net income. Net income is an entity's income minus. Okay, I think I just read about this already for you guys. We're up to the balance sheet. Sorry. All right. So the balance sheet is the financial statement that tells us about a company's assets, liabilities, and shareholders' equity. The balance sheet tells us what a company owns and what it owes, as well as how much capital has been invested by shareholders, right? Fraser, you asked that question in the beginning, right? When a company gets a round of funding from investors, where does it go? And it comes up in the balance sheet. The balance sheet is the financial statement that tells us about a company's assets, liabilities, and shareholders' equity. The balance sheet tells us what a company owns and what it owes. This is the same thing twice. The components of the balance sheet is assets, liabilities, and shareholders' equity. Right? So an asset, any item or resource that a person or entity owns or controls with expectations that it will provide economic benefits in the future. And now there's a few different types of assets. There are, and we're going to define them all. There's current assets, there's financial assets, there's long-term assets, and then there's intangible assets. And I also want to say, on the balance sheet, there's sometimes also a lot of financial trickery, and people are inflating the balance sheet, making it look like they have more in assets than what they own. And I will show you guys what that looks like momentarily, right? So current assets. Current assets are assets that can be easily converted into cash within a year or less. Current assets are also known as liquid assets because of the ease to convert into cash. So examples of current assets are cash, accounts receivable, and inventory. Do you guys know the definition of accounts receivable? It's okay to say no if you just want to type it in the chat or say it out loud. Okay. I'm guessing you guys know what it means. That's fine. Okay. Financial assets are assets that are investments in the assets and securities of other institutions. So stocks, bonds, government bonds, etc. Right? A company can go and buy Apple stock. A company can go and buy real estate and rent it out to other people. A company can go and buy bonds, whatever the case might be. They can hold assets under the company name.
But can you go over the accounts receivable? Sorry.
Yes. Yes. Let me just get, because I know these things aren't in my brain. I just want to get a nice, concise definition for you guys. So I'll talk through while I'm looking it up. This is what I gotta do. So pretty much accounts receivable. Let's say, Francis, I used to do consulting. Let's say I was going to do a website for you for $2,000, right? We agree upon that, and you give me a $1,000 deposit, and you say, Jeff, when you're done with the website, I'll give you the other 1,000, right? You would count, an accountant would count that first $1,000 as revenue, but that other $1,000 that we both know you're going to pay me once the job is done isn't quite revenue yet because I didn't receive the money and you didn't receive a finished product. So now that's called accounts receivable. So it's money that is owed or expecting to be received upon the completion or delivery of a good or service. Does that make sense?
Got it. Yeah. I sucked at accounting 101, so
It's okay. That's why we're here.
I think I
You
took
feel
the
me?
class 2 times.
No worries. No worries at all. That's why we're here. We're all here to learn. All right, then you have long-term assets. Assets that cannot, and that's also called fixed assets. You might see that term. Fixed assets and long-term assets are interchangeable. Assets that cannot be readily and easily converted into cash. Assets that are being held for more than 1 year, right? So land, buildings, equipment, these are all long-term assets. And then intangible assets. You know what? I actually want to correct myself. I know I said property under financial assets. So property doesn't fall under financial assets. More so equities and bonds. But real estate, someone owns real estate, that would be under long-term assets. And then you have intangible assets. And this is where a lot of the financial trickery happens. Assets that have economic value but don't have a physical form. So for example, goodwill. You might see a company saying they have $30 billion in goodwill. What the hell is goodwill? You know, there was, I forgot which company it was, but they had something like $10 billion in assets, and like $3 or $4 billion of those assets were goodwill. So these aren't anything tangible. So goodwill, let me define goodwill for you. Because it's a little bit of an abstract thing. All right. Is the goodwill is the value of a business's brand name, customer relations, extensive customer base, things like that, right? But then there's also the definition of goodwill, that if a company buys an existing business, let's say a company is worth $10 billion, but we were able to buy it for $5 billion. We would say that we got another $5 billion in goodwill, like that money that's left over, right? But you see how that's just such a, like a company would go and say, hey, we want this company for $5 billion and it's really worth $20 billion, or it's really worth $30 billion, right? Like how are you valuing this company and coming to this goodwill number? So to say, like, that's another example of how, like, you might read a company's balance sheet and say, like, oh wow, they have 20 billion in assets, and then you might see like half of that is goodwill, and then it's just like that company doesn't really have 20 billion in assets. Does that make sense?
I'm sorry, can you just go over that one more time?
Yeah, no, not a problem. I know this is a little confusing, and I know sometimes we expect these companies to be doing the right thing, so I get it. So let's say we went and bought a company for $5 billion, right?
Mm-hmm.
Yes, hopefully one day. When you go and buy that company, if that company is worth more than what you bought it for, you can report it on your balance sheet as goodwill. Does that concept make sense?
If the company is more, if it's more than what you bought it for?
Yes.
Okay. If the value of the company is more.
Yes. Right.
Okay.
So you bought the company for $5 billion, but you're saying it's worth $20 billion. right? And then you can say, oh, there's $15 billion in goodwill.
Gotcha.
Right. And then a key word is this is an intangible asset, right? So this 15 billion, you can't touch it, you can't see it, you can't feel it. It's, and I say this respectfully, like it's almost made up. And companies can use this goodwill to inflate their balance sheets, and companies do it all the time. Does that make sense? You know, so yeah, if you buy a company and you want to say, and a key word is that you want to say it's worth more, you can literally report that as an asset on your balance sheet, and companies do that a lot.
Wow.
Yeah, I gotta find a good example of that for you guys. And then things like trademarks and copyrights and brand value, things like that, right? Companies can report that as an intangible asset. So the stuff around intangible assets can get very tricky. And if, you know, so when you go into the balance sheet, and we'll go through a balance sheet example, you just gotta make sure you're really investigating those line items. Even with real estate, you know, a building could be worth, you know, a piece of land could be worth $1 million, but you could go and say like, hey, I would only sell this property for $2 million. So that means it's worth $2 million, you know, and now you just inflated your land value by $1 million. You see what I'm saying? Like these companies do things like that. So, you know, you just got to really like investigate what they're saying and what they own. So now liability is something a person or entity owes in the form of money or another asset. A liability is an obligation between one party and another that has not been completed or paid for. So types of liabilities. There's current liabilities, which is debts payable within 1 year. So like wages payable, interest payable, short-term debt, dividends payable. So pretty much, right, as a business, you know, let's say I hired one of you guys for like $1,000 a month. For the full year, we know I owe you $12,000. And, you know, as each month goes by, your current liability is being reduced by wages payable. Does that make sense? This is a good example. Yeah. Right. So that's what they say, right? So these current liabilities, or whenever you see like wages payable, interest payable, dividends payable, it means that you know you have to pay this money at some point because it's owed to somebody. That's all that means. But it hasn't been paid yet.
What's the dividends payable? I don't think I've heard of that. I think I know interest payable, wages payable.
It's okay. It's still the same concept, right? A company might say, hey, we're gonna give out you know, $1 per share. Let's say a company is trading at $50 a share. They might say we're going to pay out $1 per share in dividends. So you already know how much you have to pay in dividends for the year. It's just the time to pay hasn't come yet. Does that make sense?
Okay, so when you say dividends payable, that's like when the company gives like a stock or share of a stock to their employees?
No, dividends payable means that the company plans to pay a dividend at some point.
To who?
To the investors.
Oh, okay.
Right. It's the investors. Whoever owns shares collects dividends, whether it's an employee or average Joe on the street. If you own a share, you get dividends. So yeah, all dividends, all payable means whatever word is in front of it, it just means that the company plans to pay, the company knows they have to pay this at some point, just the time to pay hasn't come yet. So whether it's dividends payable, wages payable, interest payable, whatever payable, that's all that means.
Yeah.
Perfect. And then you have long-term liabilities. So that's usually just like long-term debt and long-term loans. So that's debts payable over a period longer than 1 year. That's another thing too with current liabilities, right? What's due within a year. So just to get into a little bit of an example, why is this important? You know, you might look at a company and say, what are their current liabilities, right? What is it that they have to pay for immediately? And then what's their revenue? You might see a company, and now this is like sometimes where things can get interesting, right? A company might be a profitable company, right? But then when you look at their current liabilities, you might see that, hey, they might have been payable for, they might have been profitable for this past year, but because of maybe new things that develop within the company, their current liabilities are larger than their revenue. So it's just good to look at current liabilities, and you want to compare that to the revenue, right? Does the company generate enough revenue to cover all the current liabilities? If the answer is yes, then that means that company is in a good space. If the answer is no, then you might have to investigate, like, will this company be profitable next year, right? And that's a real thing.
Now, when you're comparing the current liabilities to the revenue, are you talking total revenue, cost revenue?
I'm talking about total revenue. So
Okay.
let's look at an example. Right, they have total revenue of 457 billion. That's pretty nice. Let's look at balance sheet. They have total revenue of 457 billion, but they have accounts payable of 72 billion, and then accrued expenses of 42 billion. So that's what, 100, maybe like 110 billion or 120 billion, something like that, in money that's due, right? So that just means that, hey, like, okay, Amazon can afford their current expenses and they can afford their future expenses. Does that make sense?
You said they can afford their
current expenses, right? Because they're already a profitable company, right? But then the accounts payable is future, right? Future expenses. So their future stuff they got to pay for, they could afford that as well.
And you saw that with the income in their, total revenue.
All right. Total revenue, you following right here, 457 billion.
Yeah.
All right. Now you see we go to the balance sheet. And you look at this, just side note, goodwill, 15 billion, intangibles, 5 billion, right? What does this mean? Who knows? But just back to accounts payable. They have income of 457 billion, but on the balance sheet, they have accounts payable of 72 billion, right? So they have more than enough money to cover the accounts payable. Do you agree?
Yeah.
Okay, so that's just an example of just comparing. And you might have situations where that's not the case. Okay. Now let's get back into this. So now, the last thing on the balance sheet is shareholders' equity. Shareholders' equity is the investor's claim on assets after debt have been paid. So equity equals assets minus liabilities. Positive shareholder equity means that the company has enough assets to cover its liabilities, right? And then there's a term called retained earnings. Retained earnings is the percentage of net earnings that were not paid to shareholders as dividends. So this is just important to know, right? Because in theory, when companies are profitable, if that money isn't being reinvested back into the business, shareholders typically want to see that money being paid out to themselves. It's like, why are you, if you're not putting this money to work, why are you just holding this cash here? So it's just something to just always, that's a good line item to know about, retained earnings. And that's just the amount of money from their profitability that the company is keeping for itself.
And the investors want the retained earnings.
Potentially, yes. Or you want to know what the company is going to do with the retained earnings.
Okay. So would that be an example, like the retained earnings is just like a carryover, like a carryover of, or extra funds?
Yep. right? Like, so we're looking at Amazon, they have retained earnings of $52 billion. Does Amazon pay a dividend? Let's just find a dividend paying company. I think Microsoft pays a dividend. Wow, look at Microsoft stock. It's a nice chart. I'll make sure they pay a dividend. Yes. So they pay a dividend of $2.48 per share. So for every share you own in Microsoft, you get $2.48.
Does that go up as like the price of the stock changes, or like is that a constant?
Yeah, the dividend is a constant number. So the company can elect to increase or decrease the dividend, but it's a constant number. Now, what changes with the stock price is the dividend yield, right? That 248 is always going to be 248. But if you wake up tomorrow and Microsoft crashed to $200 per share, for example, right, you'll see the dividend percentage go up. But the 248 is still the same.
I understand. Exactly. Okay.
Yep, good question. So let's see. So they have retained earnings of 57 billion. I want to see how much, what did they pay in dividends? But I mean, retained earnings really is just the company, that the amount of money that the company is keeping. So let me see. I could do the quick calculation for dividends. I just gotta see how many shares are outstanding. 7.5 billion shares outstanding. Okay, it's a big number.
So that means that there are a little over 7 billion shares that like they have available for purchase, or is this already bought?
Yeah, shares outstanding is the amount of shares that are in public hands.
Oh my God. Okay.
Yeah. So I mean, so either investors hold it or the company holds, but this is the total shares that are out there in the market. And so I did an estimate. So they have 57 billion in retained earnings, and then they have they paid $18.6 billion in dividends last year, based on this 248. Or do they pay? I don't know if they pay quarterly or monthly, but whatever well, this is for the year, so they're going to pay out $18.6 billion in dividends for the year. And retained earnings is just the amount of money that from profits that they're keeping. So let's see. Let's go to the income statement. Oh, you know, so that math kind of works out, right? 67.8 billion, let's just call it 68 billion in net income. They paid out almost $20 billion, or 18.6 to be exact. And then you have 57 billion in retained earnings. So yeah, that is retained earnings, right? And then the company, you know, I think it's just good to know like what they plan to do with this money. You know, are they going to invest in things? Are they going to hire more people, etc.? So that's just something good to know. Now, lastly, we have the cash flow statement, right? Cash flow statement provides data around all the inflows and outflows of cash from a company's ongoing operations and investments. Cash flow statement gives us insight into how well a company is managing the cash that's being generated through various activities, right? So there's three types. There's cash flows from operations, cash flows from investments, or cash flows from financing activities. Pardon me, guys, I have a little bit of mucus. Cash flow from operation tells us how much money a company brings in from its regular business activities. Cash flow from operations is an important benchmark to determine the financial success of a company's business activities. Cash from investing activities includes any source and uses of cash from a company's investments. A purchase or sale of an asset, loans made to vendors or received from customers, or any payments related to a merger or acquisition are included in this category. In short, changes in equipment, assets, or investments related to cash from investing. And then there's cash from financing activities, which includes the source of cash from investors or banks, as well as the use of cash paid to shareholders. Payments of dividends, payments for stock, stock repurchases, and repayment of debt principal, so the repayment of loans, are included in this category, right? These are all financing activities. Changes in cash from financing activities are cash in when capital is raised and cash out when dividends are paid or loan payments are paid, actually. Thus, if a company issues a bond to the public, the company receives financing. However, when interest is paid to bondholders, the company is reducing its cash. Does this make sense, guys? The cash flow statement.
So is that, remember my question earlier about like if they get funded?
Yeah. So it comes up in two areas. It comes up in the balance sheet and it comes up in the cash flow statement. Yes. So let's look at a real example of cash flow statement.
So what is?
I'm listening.
Sorry. The cash flow, would that be considered like revenue and the expenses? Like what does that fall under?
Yeah, so cash flow is its own financial statement, right? But the cash flow statements gives you a very clear picture. Because remember I was telling you how there's a lot of financial trickery that can happen in the balance sheet and the income statement around inflating numbers and making numbers appear as they are, right? Like the cash from operating activities, this is purely like, hey, through our operating activities, are we generating positive cash flow? That's a very important question, you know? So that tells you, that gives you an answer, yes or no to that question, and it also tells you how much, right? Then you have the cash from investing activities. That tells you once again, you know, what kind of investments is this company making, and where are those investments going? You know, and I want to say cash from investing activities is okay to be negative, right? A company investing into things is a perfectly fine thing. It's just to know what are they actually investing in, you know? So, you know, I mean, right here, we don't know, right? This tells us, hey, cash from investing activities is negative 25 billion. And it was 21 billion is into capital expenditures, right? So we defined capital expenditures already. Let's just go back to that definition. Where was that? Whoops, you don't want to put a blank one. Where is CapEx? CapEx is probably under the income statement. Yes, right. Funds used by a company to acquire, upgrade, and maintain physical assets such as property, plants, building, technology, or equipment, right? So Microsoft in the past year, for the trailing 12 months, they have spent $21 billion on capital expenditure. So I would say that's probably a good thing, you know, and that and that CapEx investment might lead to more profitability and revenues down the road. Now you have cash from financing activities, right? Which is, once again, it's okay to be negative. If it's negative, right, it just means that they're paying things down, right? So they paid $16 billion in dividends, right? So that's money out. They bought back $26 billion worth of stock, even though it says negative 26. That's really what that means. They bought back $26 billion worth of stock. And then they also paid down $8 billion in debt. So like, you know, this is actually, I'm completely fine with seeing this negative $54 billion. I think these are all positive things for the company. Buying back stock, paying dividends to investors, and paying down debt, there's nothing wrong with that. So yes, I just want to say, I know in the balance sheet and the income statement, negatives are almost never a good thing, but in the cash flow statement, when you really take a look at the cash flow statement, negatives can be an extremely positive thing, except for cash from operating activities. You really want to see that profitable. You want to see that a company is generating cash flow from its operation. If it's not generating positive cash flow from its operation, that's not a good look. And if a company is profitable, but they're not generating cash flows from its operations, then that's actually really a very bad look. And you may need to really just investigate why is that. And then you have the net change in cash, and you know that comes out to be a positive 1.9 billion. But I just want to just go back to, even if this was negative, right? If it was negative primarily because of like their financing activities and their investing activities, right? That's okay. The company's investing in themselves and they're paying down debt and buying back stock and paying investors. That's not a bad thing at all. Any questions about cash flow statements, or any thoughts on just how like the cash flow statement could be a little bit different in terms of how we're interpreting it?
Just a quick question. You said with the cash from operating activities, if it's what, negative, just so that gives you a clear indication that they're not doing good.
Yes.
If it's a negative, right?
Yeah, but only for operating activities. So that tells you that whatever operation they're running, it's not a profitable operation. They are not generating cash flow through that operation.
Gotcha.
And once again, just to go back to financial trickery, a company can be profitable and have a negative cash from operating activities. That's a very real thing.
Oh, can you say that again? I missed that. I was just taking notes.
No problem. I was saying that just keep in mind, right? Like, you know, and you want to look at all these things together, the income statement, the balance sheet, and the statement of cash flows. A company can be profitable, meaning that their net income is positive, but then we look at their cash flow statement, their cash from operating activities is negative. So I'm just saying that like financial trickery is real. And even though that sounds like that makes no sense, but because companies have mechanisms of inflating earnings, you know, that's something that you might come across. Even though it sounds crazy, how can a company be profitable but not generate cash flow from operations? But because of financial trickery, that's why that can happen. So that's why this is very, very important. I mean, something I also look at very closely. Also, PEEP, right? Look at this on Microsoft. Going back almost 6-7 years ago to 2015, every year they're increasing their operating activities. I mean, they're increasing the cash flow from operating activities. That's a very positive sign. You know?
Is it every year increasing?
Yep. You see the chart right here?
Yeah.
Right?
Oh.
Every single year they're increasing their cash flow from operating. So that means that, you know, they're not just profitable, they're not just generating cash flow, but they're growing their cash flow. That's a really good look, right? That's where you want to be as an investor, right? That, you know, when you're investing in this company, their cash flow is scaling up. Does that make sense?
Yeah.
Cool. You know, so I thought this topic was going to run a lot longer, but it did not. So I maybe just want to take a stop here and just see, you know, anyone have any questions or thoughts? I know this might have been a lot to digest.
That was amazing. You made it, really simplified it. I wish you were my accounting teacher.
Word, right? I mean, I am for sale.
I agree. That was really good the way you broke a lot of that stuff down and explained a lot of things. There was a lot of stuff that I had heard previously, but there were definitely some things you touched on that the way you explained it, it gave me a different vantage point from which to look at it. So that was good. It'll help me remember those things a lot easier.
Yeah, for sure, for sure. And I know this is a kind of a big topic, but this is probably one of the most important topics, especially for you guys who really want to be like long-term investors, or for you guys who want to be entrepreneurs, right? These are transferable skill sets. If you don't know how to read an income statement or a balance sheet or what these things represent, or how companies can try to fool you, you can you won't be as successful as someone who is equipped with this knowledge. So that's good. What else did I want to maybe show you guys? So I know I sent this in the group chat, but I don't think too many people responded. But on the website, and I will send it again, so don't worry about it, but just follow along. I have 2 learning modules. There's this fundamental investing learning module where especially these topics around financial trickery, they talk about that a lot in the Intelligent Investor. So I would recommend you guys go to my website, and I'll drop the links in the group chat, and check out these different things, right? The interpretation of financial statements, the Intelligent Investor, this security analysis, part 1, part 2, part 3, part 4. This is also great. I feel like this is like Warren Buffett and Benjamin Graham, and David Dodd are the people who Warren Buffett learned from. And I think Benjamin Graham actually trained Warren Buffett. And this is how Warren Buffett learned how to do his financial analysis. So if you guys just want to get, I think it's one thing to know like what is an income statement, what's a balance sheet, but I think it's another thing to understand how to interpret these things. And all these videos will really give you a good foundation on how to interpret these things. Does that make sense, guys?
Yes. You said you dropped the link in the chat?
I'm going to. I dropped it a few weeks ago, but I don't think anyone responded, but that's okay. And then if you guys really want to get a good and I really recommend this. And once again, if you're going to be an entrepreneur, an investor, a long-term investor, whatever you want to do, if you want to buy private companies, you need to know accounting. And we have this whole learning module right here on on accounting, right? Financial statements overview, balance sheet, statement of retained earnings. It's a whole video just on retained earnings. It's that important. Income statement, basic accounting definitions. I'm sure there's a cash flow statement. Journal entries. This kind of shows you how these things are built. How do you build an income statement? How do you build, I just feel like, if you guys understand these things, things will just be much easier for you to research. So we have these 2 on the website. I will drop them in the group chat after the call, so don't worry about it for now. But
so you're gonna put them in the Telegram?
Yep.
Okay, perfect. Thank you.
We just put it in the Telegram now.
I just dropped it here in the chat as well.
Okay.
Yeah, I was gonna say that too.
All right, I'm gonna drop it in the chat as well. Perfect.
Thank you so much.
Yes, absolutely. Okay, you already put them in there, Raz. Perfect. What else did I want to say? Okay, so I guess we don't have too much time left, but all right, so we're gonna be meeting again next week. I don't even remember what's the topic for next week. Let me check our calendar. Oh my God, I'm not sure. Am I sharing my screen still?
No.
Oh, so did you see the website?
Mm-hmm.
Okay. So this is what I was showing you guys on the website. I'm sorry, my screen wasn't sharing. So these are the videos on the website.
Okay, cool.
Yeah. So these are the ones. This is the fundamental investing learning module, which is going to teach you a lot about how to interpret financial statements and what to look out for in financial trickery. And then this one right here is just accounting basics, you know, and I feel like this is like the most important thing. One of the most important things that you guys are learning here. And so yeah. So another thing too, all right, so do you guys, can we maybe do Wednesday at 6 p.m. or 7 p.m. to just do like an ideation session where all we're talking about is what we're researching, what we're investing in, what we're looking at. Is that okay for everybody? 7 p.m. New York time?
Yes.
Okay, perfect.
Yeah, that works for me too.
Okay, perfect. And Vanessa, you know, there's a few things I want to talk to you about. Can I call you after this call?
I've been waiting for your phone call, sir.
Yes, I know. I've been dragging my feet. All right, so I'm gonna call you after this phone call. Okay. So as always, thank you guys for making some time. You know,
Oh, Jeff, I just wanted to add, I'm sorry, I didn't mean to cut you off. So for next week's agenda, we're going to be going over how to use the stock screener. And if you see in the chat, I just dropped the FinViz, which is one of Jeff's favorite. Might be good for you guys to check it out. It would also be helpful for Wednesday's call. And like Jeff said, we're just going to try to keep you guys abreast with all the materials so that you guys can review.
Yeah, you know what? I'm glad you brought that up. So, and you know, there's an element that I'm kind of doing this program on the fly, even though we brought some structure to it. But I'm almost feeling like before we get into the stock screener, we should maybe do, or maybe I could do that all in one session. But I was thinking maybe we should go through financial ratios, right? Because the stock screener, and I know we have this document. Let me see if I can just find it in the OneDrive. Let me just find it real quick and pull it up. But I just want to get you guys consensus real quick.
We have a cheat sheet for the ratio.
Yes. Yep, we have that cheat sheet. Let me just get to it. Just give me 30 seconds.
I do think with the resource and the FinViz, it's really going to add to how you guys walk away from today's session, because I already feel like most of you are going to go and continue to study. So there's going to be some really great tools to just implement with that and just dig deeper.
Yep. So we have this, and I can reshare this in the chat. That's not a problem, right? But when you're using a stock screener, right, there's all these things, right? Earnings per share, price to book, price to sales. Like, you know, if you don't understand what these things mean, you can't use the stock screener well. And let's go to FinViz for you to see. All right, like you go to the stock screener. All right, and like you see, they're talking about long-term debt to equity, they're talking about quick ratio, they're talking about dividend yields, price to book, price to cash, price to free cash flow. By the way, free cash flow is the operating cash from operating activities. So free cash flow is the cash from operating activities. Whenever you hear that term, that's what they're talking about. There's net profit margin, you know, so these are all financial ratios. So if you guys don't have a good understanding of financial ratios, it might be a little tough. So I'm thinking maybe I think we could do it all in one session, but maybe the first half of next week's session we'll start with just going through this guide and talking through it, so you guys can look at it on your own. But then we'll talk through it together, and then then we could also get into the stock screener stuff.
Are you going to send the guide in this chat as well?
Yes, more than just sending the guide, I am going to send you guys the folder. Just give me 30 seconds to pull it up. Perfect. Share. You know what? Let me go to the other one. Bear with me real quick, guys. Maybe it's on the cohorts. Yep, perfect. All right. So I sent you guys the folder. So you once again you have all the curriculum presentations right here. I'm going to upload this week's presentation right once we get off the call. Then you have this resources folder, and then we have like this fundamental analysis cheat sheet. So you guys have it right here.
Can you put that in the Zoom chat too, so I can have it on my laptop?
Yes, I just put it on the Zoom chat actually. Did I? Or am I bugging? Maybe I didn't. No, I didn't.
You put it in Telegram.
Oh, whoops. I did a DM to Raz. Okay, it's in the Zoom chat. Also, if you guys don't know, you can download Telegram on the computer, and that makes it easy also. Yep. All right. Any last final questions or thoughts before we part ways?
Thanks a lot, Jeff. This was amazing. This stuff always scares me, like the balance sheet, income statements, and all that, but you really simplified that. You have a true brother.
No, you're welcome. And it just takes practice. And I know it's a big topic and it can be intimidating, but I'm here to help support you guys. And let me send you guys my mentoring link, because I feel like no one is doing mentoring. So if you guys want to talk about this stuff more one-on-one and get more in depth, we could do that as well. Let me just get that for you guys before we go. So I just want to encourage you guys to do some mentoring. Perfect. And I'll put it in the Telegram. So yeah, so if anybody wants to work on some of these things a little deeper, feel free to just grab time on the calendar and we could do that.
Awesome. Thanks, Jeff.
Yes. All right, you guys have a great weekend and we'll speak soon. And Vanessa, I'm going to call you right now.
Okay, cool.
Yep. All right. Thank you.
Next week again, right? Next Saturday.
Yep. We're going to meet next Saturday. All right.
And
thank you, guys.
One question. I'm sorry. I know you said you're going to close out the membership soon. Did you say that?
What do you mean by closing out the membership?
Because I know you said at a certain time you're not gonna allow new members.
Oh, yeah. So whoever's in the cohort is in the cohort, right? Like somebody trying to join today, you just missed the first 4 or 5 weeks. I have to wait for the next go around. Gotcha. Yeah. So, but if you know people who are interested, you can send them the YouTube link. You can send them my website, because I have a bunch of resources on there. But they just got to wait for the next go around with the program.
Okay, awesome. Thank you. Have a great day, everyone.
Yes, thank you. You too. Yeah, bye.
Bye.
Or Vanessa, you can just stay on the call because I think everyone's just going to hop off. We can just talk on here.
Okay, that works too.
Yep. Are you going to hang up, Francis?
Sorry, yeah, I was just copying the
Okay,
link.
no problem. Take your time.
I don't want to lose it because I want to bookmark it. Sorry, one second.
Gotcha, no problem.